results. Revenue at 3.17 billion euros, up 4.2% year over year.
Reporting third quarter sales up 4.8%. Franklin Golf Romeo.
The Fed policy will be driven by the pace of the data. Same policy will remain accommodative.
Futures off session low, still down about 1% on the day for a little more than 4 pennies.
As Seth has already introduced. And what I'm going to do is spend maybe the next 45 minutes or an hour talking about why the strategy works like it does, why, as Seth mentioned, that former floor traders or current floor traders, anybody brought up in the professional side of trading, why we like these kinds of strategies, and it'll make sense once I go through and start putting these together for you. But to give you just a little bit about my background, spent 2 years on the floor of the Chicago Mercantile Exchange, the runner thing, the assistant trader, right, working my way up to hopefully trader one day. Well, I was actually hired by one of the most renowned derivatives tradings out there. It's called Susquehanna Investment Group. Seth is very familiar with them. And they hired me on the CME and put me to work on the CBOE as a market maker. So for 9 years, from 1993 through 2002, that's what I did. I was the market maker taking the other side of the trade. And, the best education came from Susquehanna and working on the floor, but I've also learned an incredible amount of trading, and the way strategies are implemented on the retail side. I learned that after I got off the floor. Okay, so I've been teaching for several years. I've been working with a lot of folks on how to improve their trading. And one thing I always like to show folks is here is a type of trade, if you've never seen it before, it's a fantastic trade that really can be used in just about any market that you can have. They work well in very volatile environments like we're seeing now. In fact, I think they work better when the volatility is higher. They can work well in low volatility environments. It's a fantastic strategy. So let's go through it. And I'm going to assume that most people are somewhat familiar with a regular butterfly. We'll go through and talk about how regular butterflies are put together, of course, just to give you a base. But a broken wing is also going to give you, I say we kind of improve we improve the butterfly strategy by breaking the wing apart. And I'll explain what that means. And the way I use these are generally just very short-term directional trades, just as Seth was saying. And short-term for me, could be a week or less. Okay.
Greg, could I interrupt you just for 1 second? Just one second. It sounds like you're breaking up a little bit. Are you on a headset or just every once in a while you'll hear just sort of like a half a word?
No, I'm not. I'm on a landline. Let me tell you what. Let me see if I can get a different landline going here, if that would maybe help us out here. 1 second.
I mean, it wasn't terrible. It was sort of breaking up, and you'd have to listen, real closely to kind of figure out the sentence. Seems to be the loudest peaks that are clipping. Okay, Brad is telling us that when it's loudest, it seems to clip off.
Okay.
Okay. Okay, go ahead. It was certainly tolerable. It was just a little tough. So go ahead.
Okay. So I've traded these 3 to 4 weeks out in time, but with the advent of weekly options, I think this is a perfect strategy to use on a very short-term option, like the weekly is something with 7 trading days or 6 trading days or even less. Okay. Now, one of the great improvements, if you will, is that the broken wing butterfly compared to a regular butterfly is going to give you a quicker profit potential. And I'll explain why that is when we get to building these, but that's one of the greater reasons to trade one. The other one is that depending on how they're structured, if wrong in your direction, you don't necessarily have to lose money on it. And that is a key thing. So when we start putting one of these together, I want you to think about this. How many of you know, or I'm sure most of you know, that a stock over a certain time frame has an expected range? We expect the stock's going to stay within a certain range over a certain time frame.
Right.
And so when we set these trades up correctly, as long as the stock stays in the expected range, you can either walk away with a little bit of money, walk away with a nice amount of money. You don't necessarily have to lose. And that is a great tool to add to your trading toolbox, if you will. So now, if we look at a regular butterfly, just for kind of a quick review, the strikes in a regular butterfly are the same distance apart. So, for example, if I'm looking at a call butterfly, I could buy the 50 calls, sell the 55 calls twice, and then buy 60 calls. So that would be called, that's a $5 wide butterfly.
Right.
And when we build that butterfly, it's really just a combination of two call spreads, isn't it? We're buying the 50-55 call spread and then selling the 55-60 call spread. And the way, that's generally taught is that you're using that short call spread as a way of financing call spread that you're buying. So it kind of looks like this. You buy the 50 calls, sell the 55 calls. That's the spread that you buy. And then you pay for or help pay for that spread by selling the 55-60 call spread. And that's the two strategies, but when you put them together, what do you end up with? You end up with a butterfly. Okay?
Right.
Thank you for watching this clip of our OptionsTribe webinar. The rest of the recording is available on OptionsTribe.com. I'm Seth Freudberg, and I've been hosting the OptionsTribe since May of 2011. We've brought in options experts from all over the world to make excellent presentations to our members. So go right now to OptionsTribe.com to learn more about options education, or you can send me an email at sfreudberg@smbcap.com.